We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Don Durrett, author, investor, and founder of goldstockdata.com. Don, how are you today?
Great, Tom. Thanks for having me back.
Always great to have you, Don. And of course, we're recording this just after the new year here on the 4th. So I'd like to start by kind of getting a sense of the macro picture now that we're into 2024 and really understand how you're looking at the year ahead. Of course, Powell came out kind of mid-December and softened his language on rate hikes. So is this the setup that we've really been waiting for the metals?
Well, yeah, for me, I mean, this is really the big question, and really the topic I really want to talk about is heading into this year. What are the expectations for gold? Why do we want to be bullish? Why do we want to be bearish? And it's for me, it's all really coming together. I did my newsletter, and I said that 2024 is going to be the year for gold. So now how can I defend that? So if we look at the macro picture, I mean, last year, going back all the way to 2020 in October, we started having this run in the stock market, and it ran really, really hard from October all the way till August. Then we had a bit of and then I expected it to roll over in September, October, and it did, but it only got to 4,200, which was the important level in the sand, line in the sand, and it held. Mm-hmm. Once it held, it just started rocking and rolling in November, December, and we had this strong year. We got all the way almost to 4,800, pretty close to an all-time high. We did get all-time highs in the Dow and the NASDAQ, but not in the S&P. S&P is 4818, so now it's down about 4,700, so it's kind of off a little bit. But the reasoning for that run last year, I think, is somewhat misplaced. With Wall Street. Wall Street is really focusing on near term. It's focusing, for instance, what made that run take off in October, November was the expectation, November, December, was the expectation the Fed's going to cut rates. So if they're going to cut rates, oh, wow, that's great for the stock market. So we had this, Santa Claus rally, and it's based on that idea. Okay, they're going to cut rates. And so the market's going to come back alive. Now we need to look at, okay, is that a legitimate reason for the stock market to be at these levels? Is that a legitimate reason to be bullish for the economy for 2024? Mm-hmm. Now, for me as an investor, I'm not a trader. I'm in this for making big money, big alpha, 3x, 5x. That's minimum 3x, but I'm trying to get 5x plus. So I'm basically an alpha investor. So I don't really care about the near term, but I care about the thesis. I care about, where we're going. And I've always said that the only reason you should be involved in gold and silver miners is because you believe that this debt bubble is going to pop. So with that background, let's go back to 2008 when it really all started. I mean, we could go all the way back to 2000, but I'm going to start at 2008 and kind of shrink it down a little bit. So 2008, the Fed came in and basically ended that recession fairly quickly by lowering rates. The recession was pretty much over in June of 2009. And then from 2009 to 2016, they kept rates at zero. And basically,
if I could just interrupt for a sec, I think, you're kind of answering one of my next questions. In that period in 2008, did the Fed adopt really a third mandate on top of employment and price stability as well?
Yes, and I think this is what Wall Street and the economists are missing. The smart macro people have picked this up, but not really Wall Street. And what I say is this idea that the Fed's mandate has changed. It used to be basically two-pronged, which was making sure that we didn't have inflation, and have full employment. Those were their two objectives: keep people working, basically, and not allow inflation to take off. And it has expanded significantly since then. Now since 2008, the Fed's mandate, and we saw that with zero rates from 2008 to 16. Their mandate now is, in addition to keep people fully employed, but to basically make sure, if you will, the stock market is going up. Because from 2008 to 2016, every single time the stock market did any hiccup at all, you saw this money injection come in. Where the hell was that coming from? Why? Right? That's that new mandate that I'm talking about, and that's why when Powell pivoted last month in December, when he pivoted to basically saying we're not going to go and fight inflation down to 2%. Well, if it gets there, great, it got there, but it's not really our objective anymore. Our objective now is we need to cut rates, and they're cutting rates because inflation was never, in my opinion, their top priority. Their top priority is this mandate you're kind of alluding to this mandate of economic stability on the financial system and making sure that Wall Street is healthy and the financial system is healthy. I think that's their number one mandate. Do not allow crisis. Do not allow financial meltdowns. It's all about manipulation and kind of plugging the dam holes in and making sure that nothing basically breaks. And so inflation, I think, is a secondary focus of theirs. So now, and I think that they raised rates too fast, basically went from 0 to 5% in less than 2 years. And by raising them too fast, they basically have damaged a lot of industries. They damaged the banking industry, the housing industry, and the auto industry. All three of those are basically struggling right now. And so now let's go back to my what I was talking about earlier. So 2008, 2016, the low rates, and then the managing the economy, making sure the stock market didn't fall, keep injecting money. Then from 2017 to 2019, they tried to raise rates and it didn't work. And you started getting we started getting a little wobbly on the economy. And everybody's like, what's going on here? Is Powell, you're losing control or whatever. And then Powell, raised rates and then he lowered rates. Before 2020, before COVID, he was cutting rates. A lot of people don't realize that. They don't talk about that. If you go back to 2019, he was cutting rates. Why was he cutting rates? Right? The economy was supposed to be growing. So in 2019, the economy was actually starting to, this whole, the economy live on its own, grow on its own. It was already having problems. And that's what I think people really need to recognize is that what people are expecting right now on Wall Street is this idea that the Fed can kind of land this plane here and get everything back to normal. Well, things were never normal from 2008 to 2019. They weren't normal. Mm-hmm. It was basically a Potemkin economy where you had government doing deficit spending. If you remember, debt was going up $1 trillion a year through that whole era. We were growing the economy with deficits. So we were doing fiscal stimulus through the whole thing in tandem with zero rates. This was a Potemkin economy. You had basically, and then they doubled it up. And then you got from 2020 to 2022, we actually increased the stimulus dramatically. And then we had rates low and we were printing like crazy just to prevent a recession. And this is on top of this Potemkin economy going back to 2008. It actually goes all the way back to 2001, but we're not going to go there. So you get to 2023 and everything seems to be going back to normal because they're raising rates and things are slowing, but you're not going into recession. However, the reason why we weren't going into recession is because you had fiscal stimulus where they had this $2 trillion deficit. Well, that $2 trillion deficit is added to GDP. So remember last year we had all this GDP growth. Well, the government and whenever it does deficit spending, when it spends money, that's GDP. It shouldn't be, but it is. So they can. So it's basically a fake growth. When you can basically borrow money, it's like saying that you have a credit card and you go and spend 20 grand that you made another 20 grand. That's what they're saying. That's total BS, right? You didn't get $20,000 in income just because you spent it on your credit card. And this is the reason why gold is sniffing around 2,000, and the reason why the bond market had some issues back in October is because we're starting to get to the point now where, the credit card bill, the U.S. government's debt cannot just go to infinity. We're at 34 trillion, adding, how much are we going to add this year? We don't even know. 1 trillion now is, small. Now we're looking at, 2 trillion plus per year. So you add all these things up. Now, what Wall Street is saying right now is that, look, we're going into a soft landing because GDP, the economy's growing and inflation's going down, and they're getting ready to lower rates. It's a soft landing, right? But what they're not ignoring is all of these things, and I'm going to give you guys 12 assumptions here that they're making. And if you can check the box and say all 12 of my assumptions are BS, then yeah, bet on that, 10% growth on the S&P this year. But so here it is. So easy peasy. So basically, they get rid of QT. QT goes away. We bring back a little bit of QE. We lower rates. Easy peasy. The economy goes all back together. Okay, so now let's look some of the assumptions. So the first one was I mentioned earlier about the economy. From 2009 to 2016 and 2019, it was basically growing on free money. So that didn't damage the economy because we don't have free money anymore. So free money's gone. So is the economy going to grow without free money? Good luck with that, right? Then you have debt expansion. So that debt expansion, we were adding debt at 8% clip. GDP's 2, and we're adding 8%. That math doesn't work. How long can you add debt at 4 to 8% clip? Something's going to break there. So now we had the work from home movement. So the work from home movement, we're not seeing that go away. So if that doesn't go away, what are the banks going to do with all this commercial real estate downtown? That's going to start hitting home this year. There's more headwinds for you. So we're just going to ignore that commercial real estate bubble, and it's not going to, don't worry about that. It's not an issue, right? Economy's going to be fine. Okay, then you got the lag effects. This is number 5. You got the lag effects of high interest rates. That hasn't hit yet. That's not going to happen, right? It's like, wait a minute. We got to get through these lag effects before we get all bullish. The next one is the weak PMIs and the weak LEIs. We just had the PMIs last week. They came in about 47. Anything below 50 is negative. So the PMI has been negative for what? I think like almost 2 years now. It's a long time. And so suddenly the PMI is going to turn positive. That's another assumption, right? And then the LEIs have been, totally in the dump, the leading economic indicators. The LEIs have been negative, I think, it's about 20 plus months in a row. They're just going to suddenly get good, right? That's another assumption. Number 7, we have weak growth in Europe and Asia. Our corporations get over 40% of their profits internationally. And if you have a recession in those areas, and if you have slow growth in Asia and you have a recession in Europe, our corporations that's headwinds for them. Those headwinds hit the stock market. So that's another one they're assuming, no issue. We just ignore that, put it under the rug. Next one is rising bankruptcies. The chart, if you look at bankruptcies right now, they are going up. They're back to like 2008 levels. Suddenly, those are all going to halt. That's another assumption. Number 9, the inverted yield curve. They're basically saying it was a false indicator. It's never been a false indicator ever.
I was going to say for the first time ever.
This time, don't worry about that one. Number 10, the Buffett indicator. This is why Buffett's in cash, and he's smart. He's one of the smartest investors of all time. Buffett's going, oh man, this isn't good. This isn't good. And that's his indicator. They named it after him. And that one's screaming. It's all-time high. It's like, oh no, don't worry about the Buffett indicator. No, that's another one we don't have to worry about. Number 11, the economy can grow with short-term rates above 2%. Now remember, we're just talking about this year, 2024. So we have rates right now about 5.25%. So they're not going to get those down to 2% this year. So we're pretty much, the Fed funds is going to be above 2 by the end of the year. So you're not going to have, back in 2019 when they tried to get rates, they were below, they tried to get them to 2, they tried to take them to 2% and it didn't work. So they're saying, oh, don't worry, and I say above 2%, I mean, we probably won't even get above 2.5. I don't even think they'll get the Fed funds down to 2.5 by the end of the year. So we're not going to have low rates this year. And so, oh, don't worry, we don't need them. Well, we've needed them in the past. So why is suddenly the economy so strong? Okay, and the last one is number 12. And I could come up with 20, but I stopped at 12. And these things are also obvious. These are all done from the top of my head. This is just a tweet that I did. It's like a lot of this stuff is really obvious stuff. I mean, there's so many, right?
Mm-hmm.
Okay, so number 12 is the large US budget deficits. So our budget deficit this year is going to be about $2 trillion. So these budget deficits, at what point do they matter? It's like this final one really goes back to this whole idea of MMT and how we've been ignoring it since 2008. I call it the elephant. It's the reason I invest in gold is I don't believe that you can have $2 trillion deficits or $3 trillion deficits and the economy just ignores it and grows. And again, it's kind of a fake economy. But that debt, I just think it matters. I think it's just going to have a lot of negative impact because someone's holding that debt. And if you're not generating enough wealth, then somebody's taking a hit there. Mm-hmm. It's like you don't get, it's like the free lunch thing. You just can't borrow, and nobody's taking a hit. It's just people are making money, everything's positive, and that's kind of this MMT mindset that we have. Mm-hmm. And I'm saying buy gold, buy silver, buy mining stocks because this is fantasy economics. And have a long-term view and just realize the U.S. government, U.S. economy, U.S. dollar, U.S. bond market, all four of them are basically getting ready to hit a wall here. We're really close. I think it's going to be in the first half of this year, probably the first quarter when it all starts turning, everything starts turning south. And this belief that we're going to get in a soft landing goes away. And that is what we need for gold to go higher. Mm-hmm. Thanks for my long answer.
No problem. Don, it's interesting that you bring up the idea of GDP growth by fiscal spending. I remember talking to Lawrence Lepard recently here, and he was mentioning to me that we also saw a lot of growth just based on really the inflation price of things. So it's not necessarily that the economy even grew, but even if we sold the same amount of things for that nominally higher price with the inflation attached, that counts as growth too. So it's really interesting to try to sit down to think about that data once it comes out. And even though it looks positive, it more than likely for a small number of growth like that isn't actually considered growth from a realistic standpoint, I would say.
Yeah. So yeah, me and Larry, we work together and we think a lot alike, very much alike. And we both got into gold for the same reasons. We are basically believe in Austrian economics. And what the US is doing, and even Europe and Japan and China are doing, it's political economics is what they're doing. It's not, smart economics. It buys you time. It's political expediency. Mm-hmm. A perfect example was COVID in 2020. Let's go print 4 trillion. We can print it, can't we? Sure, print it. And then what happened? They created inflation. So, they thought they could get away with it. Political economics. And von Mises says, you're not getting away with it. And they didn't. And now inflation came in. And, I call it the Potemkin economy. I mean, it looks great. I mean, you go and you go to the stores and they're full, the restaurants and they're full, and you go, what? Everything must be going great. Look at everybody's spending money. But you need to look at it holistically. Where did they get that money? Where did it come from? What can maintain it? What can sustain it? And so a lot of people are like, who was I watching? I was watching somebody who was saying that, debt's not people don't understand debt. It's not really that important. Well, it's not important until it is. And for me, the U.S. is in trouble because of two things. The first one is we have become dependent on debt, literally dependent on it. We can't pay our Social Security. We can't pay our Medicare. We can't pay our defense budgets. We can't cut them. And so we have to pay through them through debt. So we're basically in a situation where we have to borrow $1 trillion plus a year. But now, with this manipulation required to make sure everything doesn't melt to the ground, it's gotten higher. So now, with the inflation, our interest payments are now, I saw this week, we're up to $1 trillion in interest payments alone. So we were about 250 billion, 250 to 3. So we've added, more than 100%, let's just say $700 billion in added budgetary, money that we have to borrow. So we were about at 1 trillion, and now we're 1.7, all from interest. So we're pretty much stuck about 1.5 to 2, and if we go into recession this year, and I think there's an 80% chance we will, we're probably going to go over 2 trillion this year, and that we've gotten to the point of no return. So our debt to GDP now is 122%. The last time I did the numbers on it. Once you get to, Luke Groman does a great job talking about this, about how once you get at a certain point, you can't come back. It's impossible. And he talks about the ways back to do it. Once you get out of balance, this far out of balance, it's the only methods of getting back to normal are just, they're not politically viable. So we're pretty much bankrupt right now. And Wall Street's ignoring it and buying stocks, just completely ignoring the fact we're bankrupt. And the only reason why we're not bankrupt yet is because our creditors haven't basically called in the loans yet. And when I say call in the loans, I mean basically dump them and say, give me cash for these. I don't want them anymore. Mm-hmm. Well, the way our treasuries work, they're liquid. You want to sell them, you can sell them. And that's pretty much what's going to happen here once the house of cards start to fall. Now, some people are listening right now and say, this guy's just full of it. The U.S. economy is the number one economy in the world. It's going to always be that way. The U.S. dollar is going to be the reserve currency. It's always going to be that way. Everything's fine. The Treasury and the Fed, they know how to manage issues, crises. We always manage them fine. We always get through periods. The business cycle always rolls over. I mean, what he's saying is what they were saying back in 2008-9. Look what happened. Look at the stock market from 2008 to today, right? The S&P went from 666 all the way to 4,700. And this guy's talking about a crash. Come on, man. What's he smoking?
Come on, man.
But I'm telling you, this year, 2024, is the year that we see the emperor's not wearing any clothes. When we get to the end of this year, it's going to be like, we're in trouble. That's going to be the end of year thing. We're in trouble. It's basically going to be just like 1932, although we won't have a depression. 1929, 1930, where once the thing we're not going to crash. We're not going to do that. But what we're going to do is we're going to stop growing, which is kind of what happened in the 30s. You just stopped growing. There were a couple of spurts in there. But the rest of this decade, I think 2024 is the year that we stop growing. And when you have a leveraged economy like we do, you can't afford to stop growing. America's basically a corporation. It's a kind of a grow or die situation here. So if we stop growing, that's bad. That's really, really bad. And a lot of people are talking deflation, and they're right in many respects. And the deflation is when you can't get asset appreciation, like stock market. Housing won't go up, stocks won't go up. You can't get any appreciation. So if you can't get any as asset appreciation, how do you give people raises and bonuses? See, and everybody talks about how deflation is very damaging, and this is how it's damaging. So even if you have no growth, it's basically quasi-deflationary because you're not getting a raise. There's no growth. If I don't get any growth, how can I give you a raise, kind of thing? And so you muddle. You basically turn Japanese, and you have a lost decade, and there's no growth. And that's where we're heading. We're heading into, I call it muddling, because we're going to be stuck in the mud. That's what happens this year. And once it happens, this is where gold and silver is going to just blast off. That's what, remember earlier in this conversation, I said, I'm going to give you a reason why I'm bullish for gold. Mm-hmm. These are the reasons I'm bullish, because once the economy stops growing and these debt bubbles start popping, people are like, I need a safe haven. I don't know where to put my money. Put it in the stock market, it's not going anywhere. It's dead money. Put it in bonds, that's dangerous because they're printing money and that's going to create inflation. That creates inflation. My bonds are going down. Uh-oh, where do I go? I'll go to real estate? Oh no, real estate's going down too. There's nowhere to go, no place to hide. And so it's going to be gold, silver, and crypto is the place to hide, believe it or not. Now, there's a people listening right now that if they're still sticking around, they're going, this guy's nuts. That's the only place to hide. He's just talking his book. But I've been analyzing the economy since 1980, and this is where it's landing right now is where I've always expected it to land. I remember back in the mid 80s, I told my dad, I said, Reagan's economics doesn't work. It's like, okay, he did fine in 81, 82 because he was taking us out of the recession. But 84, 85, 86, he was doing the same thing. I'm going, this isn't good economics. You do realize this. Mm-hmm. But he was a Reagan fan, so he thought I was nuts back then. It's like, we're fine, Don. Everything's doing great. Look at the economy. This is the best economy we've ever had. It takes years for this stuff to unfold.
Mm-hmm. Well, and that's exactly what I want to get your take on as well is, we've heard so many times, especially kind of being in the gold community here, that the economy is going to crash, the recession is here. We hear this over and over again. Why do you think it's 2024? Why do you think this, let's say, crash, for lack of a better word, is on our doorstep now?
The reason why is because last year, we probably should have had a recession last year, and a lot of people expected one. But you had a combination of a lot of money that was still making its way through the system that they printed, mm-hmm. in tandem with the fiscal stimulus. Those two things kept people employed. And those two things it was kind of a mini crack up boom where things just kept going up when they really shouldn't have, where you just, good example was the November, December rally in the stocks. It's like, if you really looked out in the next 6 months, you would have sold, but everybody was buying because, they just in denial. So I just think that last year's move was really that final little crack up boom where people were doing the irrational. Mm-hmm. Because, I gave you the 12 reasons why this economy is in trouble here. It's not in great shape for now. I mean, the Fed has been basically manipulating this thing since 2008, right? In 2009 and forward. And so that's what the Fed's doing. It's basically juggling it. But they had tools. They had tools to do that. Their tools were, hey, we'll just take rates to zero. Well, they can't do that in 2024. So I just think that all the damage that was done from 2000 to 2023, all the damage that was done through manipulation, basically, when you give people free money, you create bubbles, but you basically break the free market. And it creates a lot of leverage. So we have a lot of zombie corporations out there that shouldn't be alive. And they're only alive because they had cheap money, access to cheap money. Mm-hmm. And right now they're losing money. I forget the percentage. It's a pretty high percentage of companies today that have negative free cash flow. It's a pretty high number. It's pretty shocking, but everybody's in denial. Mm-hmm. Companies are losing money right now. And everybody thinks everything's fine because those 7 companies made the stock market look so great last year. Economy's not in great shape. And so it's a matter of, will these low rates, and again, I told you, we're not going back to zero in 2024. The lowest we're going to go is maybe 3% on the 10-year. That's about as low as you're getting in 2024. And then, and then it might start going back up by the end of the year, which is going to scare the hell out of people. So you have, people say, oh, you're a doomsayer. I'm saying no. I'm basically analyzing this thing totally logically, economically, saying if you count every dot and you connect every dot, this thing screams problem, 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 going all the way back to 2000s to today. You can't just print your way to prosperity. And I'll wait it out. If it takes me, 2, 3, 4 more years for this thing to finally, burst, I'll wait it out. So what I've been doing this. So I started back and give people a little overview. So people, if they think I make any sense, they can kind of follow my strategy. So I started this in 1991. I bought a gold mutual fund because I believed that Reagan's and the US's trajectory of using debt to maintain the economy was not going to work. Mm-hmm. Now, through the 90s, I looked like a complete fool. But once you got to 2000, I started to look smarter. And so, and that investment from 1990, that mutual fund actually has zero cost basis today. So I've gotten paid in dividends that covered it. And it's going to be worth probably that one investment is probably going to be worth $250,000 when I end up selling it, maybe a little higher, with zero cost basis. So it's worked out well. So then in 2004, I wanted to start buying silver stocks. Well, guess what? There were no silver mutual funds back then. There was no silver ETFs back then. SIL and SLIJ came after 2004. So I had to learn how to analyze silver mining stocks. Mm-hmm. There was no books out there. So I ended up writing my own book in 2010 after I learned how to do this. So I started buying juniors, and I didn't know what the hell I was doing because there was no books. I had to self-learn. And so I started collecting stocks, basically, 2004. Today, I have 164 stocks, individual gold and silver mining stocks, and then another 9. I have 3 mutual funds for majors. They're basically for income, and then I have 6 ETFs for diversification. So I have those 9, plus I have physical silver. And then I have 164 positions. Now, some people say, 164, are you out of your mind, Don? Well, for me, I don't care if a company goes bankrupt because I have so many positions. I keep my allocations low. But guess what? If you're right, what I do is I do about 0.25% to 0.5% of my allocations if it's a high risk junior. Then I do about 0.5% for somewhat of a risky producer, if you will, or that I like it. And then I'll go a few times I'll go up to 1% for a quality producer. So I keep my allocations very low. But guess what? If you do 0.5% or 1%, it can turn into a 100-bagger or a 50-bagger, and you can make a lot of money. Mm-hmm. For instance, and some of these stocks, it's amazing. You don't have to put a lot in if they're become baggers. So I bought Crocodile Gold. I invested $7,000 in Crocodile Gold back, 2005, 6, somewhere in there. They got bought out by Kirkland Lake, and then Kirkland Lake went to the moon, and now I own Agnico Eagle. So that initial $7,000 is now worth, I think, $135,000. So that's well over a 10-bagger, and I think it's going to go up 3x. Now, the only reason I haven't sold it, I haven't sold any of it, by the way. I took 0 profits out of it. I'm buy and hold. Mm-hmm. I think it's going to go up another 3x, 3-baggers. So that's going to go up 4 times. So it's going to go to $400,000 off a $7,000 investment. So you don't have to you don't need to put big allocations in these stocks. If they work, they work. Mm-hmm. And so that's how I do it. I just collect stocks and then buy dips and make sure that I have a big enough position in a stock. For instance, right now, I think the best place to be is in producers. And because silver is so much highly levered versus gold, silver, is less than 50% of its all-time high. So I think you're getting at least 2x leverage on a silver miner. Mm-hmm. So I basically said to buy the Mormons. The Mormons, the reason my friend called them the Mormons, because you generally don't want to marry a stock. And I actually believe that, because you don't want to have high allocations. If you marry a stock, you might have a high allocation. But he said, I'm buying the Mormons. I go, what? He goes, yeah, I'm going to marry a bunch of these silver miners. So, okay, I'll call them the Mormons. So I came up with 7 names, and I wanted to make sure that I had a good allocation in all 7. So the 7 are, Hecla, Pan American, First Majestic, Fortuna, which is, not really a silver miner. Gosh, I think I'm missing. I said First Majestic. Silver Crest Metals is another one. I think I'm missing one, another producer in there. Oh, I'm missing Coeur Mining. And I said to buy these to the bottom. Now, Coeur went all the way to 225, 220. I don't think I got to 210. Not I got it to 210. And then it bounced all the way almost to $4. And now it's back down. Endeavor Silver. Oh yeah, Endeavor Silver. That's the last one. They're one of the few Mormons that haven't bounced. A trader, somebody told me the day they bought some at $1.82. These stocks are all basically print as 5-baggers at higher silver prices to me. And so I think the risk reward works if you're a long-term investor. I really don't think people should be trading these stocks or even short-terming them. You got to be a believer in the stuff I'm talking about, the debt bubble and whatever, because these are speculation, highly volatile stocks that can, you can go under 25% in 2 weeks. And most people can't handle that. Me, I have no problem because I have so many positions. It's like, unless the story changes on the stock, I'll hold it. I mean, I might hold it down to 9% down and then double up on it if I still like the stories. But it's unbelievable how some of these juniors, how cheap they get, even though, the silver in the ground, the gold in the ground didn't go anywhere. It's like, why are these stocks so cheap? Southern Silver, for instance, probably my favorite optionality play for silver miners. It's like, they have 300 million ounces of silver equivalent in one project, and nobody wants to touch this thing. It's like, wait a minute, it's trading like 30 cents an ounce in the ground. It's like, it's pretty insane. And so that stock has, crashed a lot from, its all-time high. So stocks like those, you don't really need high allocations, and then they can really take off. So that's just overview. I want to give people that an overview so they want to emulate what I do.
Mm-hmm. Don, you mentioned, when this crash comes, you're going to hide out in gold, silver, and cryptos. Are you including the miners in gold and silver? And how do you see, let's say, the dynamics of a mainstream market sell-off affecting the metals and the miners?
Yeah, it's 2 questions. I'll do the first one first. So where do I hide out? So my belief, so when I got into this, back in 1991, I was always in it for the US government basically running into trouble with their bond market. Mm-hmm. For me, it's all about bonds. Bonds are more important than stocks. It's kind of odd, but it's true. Bond market has trouble. The stocks they're in big trouble. And so I think that the US bond market is in big, big doo-doo. And because we are dependent on foreign money, we cannot finance our internal debt because it'll just suck too much money out of the economy. And you just won't be able to grow. And so if those foreign dollars dry up, I think it's problem city basically. And I think that's going to happen over the next 3 years. So my feeling is that when this thing does finally pop, gold will go to at least $3,000. And I think $3,000 is a very conservative number. Now, if you use a GSR, gold silver ratio of 30, mm-hmm. that takes silver to 100. Now that might, people will say, well, that's a little aggressive, but a GSR of 30 really isn't crazy talk. It was at 39 in 2012. Mm-hmm. So I think if silver would have kept running to 75 back in 2012, it would have kept running. The GSR probably would have squeezed down to the low 30s. So a low 30 GSR is not crazy talk. So I expect, silver, when gold goes to 3,000, to be somewhere between 80 and 100. And so those are some really, really high numbers compared to today, especially for silver miners. You get this $80 silver, these silver miners are going to be generating a boatload of free cash flow. Now, again, $3,000 gold to me is a conservative number. I think we're going to at least 3,500. Now, what I'm going to do is and this is kind of crazy because I created a website. I wrote a book. I've been collecting miners for 20 years. I'm actually walking away. I'm going to sell to the top here.
Mhm.
My 164 positions will all be sold in this next run. I probably won't own a single gold miner when this thing's over. And the reason why is because it's a lousy business. It's a cycle business. It's kind of, you just want to own it. The only time you really want to own this stuff is when it runs.
Mhm.
You don't want to own gold and silver miners during downturns or flat, or when it's flat, because it's an ugly business, because it's a cash business. They're constantly raising money. It's bad business. But gold is the one safe haven that people are going to run to. The whole extra pyramid, the bottom of that pyramid, that's where people run. They're going to run to gold. And the middle class will run to silver because they can't afford gold. And so what I think is going to happen is this run's going to last for about 2 to 3 years. And so I'll start selling at $50 silver. So 50, 60, 70, 80, 90, 100. I'll sell a little bit of my miners each time it goes. And then I'll hold a little bit at 100, but once we get to 150, I'll be out of my miners completely. And then once gold gets to about 3,000, I'll probably be about 70% out of my miners, somewhere around there. And then I'll be completely out about $4,000 gold. And I will stop those out. So let's say that I'm selling to the top. So let's say that we top out at, like, say 3,400, and then it starts correcting back down. Once it starts correcting back down, I'll be getting out. And so if we get volatility, I could get, be completely out. But I'm thinking within 2 to 3 years, I won't own any miners. I've always thought this is a once in a lifetime trade.
Mm-hmm.
I call it a trade, but it's really an investment for an outcome. Mm-hmm. It's kind of the Michael Burry play, where he put all this money into MBSs, and then once it was over, he got out of those and said, okay, we're going to go back to stocks, pivoted out. It was kind of he saw this once in a lifetime deal, and he did it. And the thing that blows my mind is I haven't heard too many people like me talk like I do about once in a lifetime, put 90% of your money into these miners. Mm-hmm. And let's see if we're right or not. I don't think I have 90%. I do if you can count my physical silver, but if you reduce my physical silver and crypto, it's only about 84% of cost basis.
Mm-hmm. So, another piece that I think maybe escapes a lot of people that are looking at this mining sector from the outside in right now are why the miners are so undervalued compared to the underlying metals. So what explanation do you have for that? As we've seen gold hold pretty steady here above that $2,000 level and really not give up a whole lot of ground in the last couple months here.
Well, it's definitely something I've thought about a lot. And I think it's a combination of two factors. One, the margins haven't been as strong as they were prior to, like, if you go back to 2009 to 2011, the margins were better. Mm-hmm. So you had, better free cash flow multiples, and you had better sentiment. And there's the second one. So lower margins in combination with sentiment. I don't know which one is a more powerful in that influence or impactor. I actually think it might be sentiment. So sentiment died in 2013. And I remember 2004 to 2011, there was some really, really strong sentiment. If you look at when gold went from 250 to like 750, the miners were flying. Mm-hmm. They were absolutely flying. There was some really, really strong sentiment in the miners. So we had some really big multiples and things were doing well. Sentiment remained strong all the way until 2012. We really didn't have any, dying. And the reason why is because we never had a real big crash. You had 2008. 2008 only lasted about 1 year. So a 1 year correction is nothing. It wasn't enough to kill sentiment. So sentiment was basically, it was there. You didn't have what happened in 2013, 2014, 2015 when gold just, collapsed. You went from 1,900 all the way down to 1,100. It went down about almost 50%. Mm-hmm. And the miners went down more than that, 70%. It was brutal, and sentiment never returned. And this is something that I harp on all the time, is that the kryptonite for gold is the economy. It's like if the economy is strong, people are, I don't need no stinking gold. I'm fine. The only time people buy gold is when they have to, when they're afraid, when they're nervous. And that's the number one driver. That's the only, in my opinion, the technical move. Now that we can talk about this, I think it's a good time actually to pivot away, is that the reason why gold went from 1800 to 2100 was really technical and not fundamental. That's why I said it. We're not breaking out here. It's just a technical move. Mm-hmm. And the technical move was the 10-year and the dollar dropping. And the dollars came back a little bit, and gold got stuck here. Gold yesterday was down, it dropped, I don't know, $20-$30. It was trading about $20-$30, then it popped a little bit today. But gold, in many respects, that move was more technical than fundamental. And what I mean by that is it was moving because of interest rates in the dollar. It wasn't really moving because of fear of people needing gold. They were trading gold, technically. You need fundamental reasons. You want people to need gold, want gold, not trade it, not to make a little profit. When gold was running from 250 to 750, that wasn't a trade. That was what the hell happened to America when 9/11 hit. Where's America going? I don't trust my assets. I want some gold. And then after 2008, you had the GFC, and people are like, "Oh my God, is the financial system going to melt to the ground?" And then finally, by 2012, everybody was like, "Oh, we're good, we're fine." And then I don't need no stinking gold anymore. The fear just went away. Then for 3 months, from May of 2020 until August of 2020, that you had fear because of COVID, and they're like, "Oh, this COVID thing could damage the economy," and gold went to the moon. And then everybody was like, "Oh, maybe go." No, it's not. Fed's got this under control. They're going to print $4 trillion. We're fine. And then gold went away. It's went away now for over 3 years. We're almost at the 3.5-year mark of this correction. And so what's going to happen is fear is going to return. And it's going to return even higher than it was in 2008. And the reason why fear is going to be higher is because Wall Street now is going to go, uh-oh, how do we restart this thing? It's like, it's almost going to be like we're going to have technology and the inventor is going to die and nobody's going to be able to figure out or restart the machine kind of thing. It's like, oh no, or you owned a bunch of crypto and you lost your private keys. Oh no, we're broke. It's going to be that type of fear level. Uh-oh, how do we get out of this? And I think that fear is going to really start in the second half of this year. As people start to recognize, all those assumptions were false. And once they have to recognize this, Wall Street has been living on basically GDP and employment. They've been living off of that, and inflation coming down, which is not necessarily a good thing, because even if inflation comes down, does that mean costs come down? No, it just means costs don't go up. But the high costs are still there. It still costs you $15 to go to McDonald's now when it used to cost you $12. So those high costs are still there. Did you get a raise? Well, not everybody got a raise. So that's what I mean. The inflation problem is still with us. That inflation problem doesn't go away easily. And that's another one that, Wall Street's kind of ignoring here. It's like, and I actually don't think that this whole 3% inflation is even close to normal. You can see with your bills, the stuff that you pay, we're getting we get these things in the mail and they're kind of shocking to us because they're not 3% increases. A lot of times they're 20% increases. What the heck just happened there? Why did that cost jump so much? Right? Because the actual inflation over 3 years was probably 25%. And so a lot of these companies are not getting around to raising their rates back up to incorporate that 25% increase so that they want to be at normal. Everybody wants to raise everything up to 25%. So we're seeing a lot of these services companies do that. Mm-hmm. And so we are seeing, so we're seeing that.
So Don, with the Fed, realistically kind of accepting a higher base level of inflation rate, as you said before, they're kind of abandoning that, getting to that 2% target. Are we going to see, in your opinion, a scenario much like the 70s where we had these waves of inflation? And is it going to be kind of siloed to commodities versus, seeing other sides of the economy like luxury goods come back down?
Yeah, I absolutely think it's going to be like the 70s. History's going to rhyme where we have waves. That this wasn't a one and done thing, because once you kind of let the inflation genie in, it's really hard to put it back in the bottle. And especially when you don't try to put it in the bottle, which is what's happening right now. They're pretending it's fixed. Mm-hmm. And so they're going to take their foot off the QT pedal, I think. And once the stock market goes down, then QT ends, QE begins. So more injection, more stimulus, which will create inflation. We'll basically go back to 4%, I think, fairly quickly. And so you get that monetary fiscal stimulus going in, monetary fiscal inflationary pressures, which I think will create another wave. And then the third wave, which, I'm not sure if I'm right on this, but I just think that I am. And I think that we're going to have another energy crisis. And the reason why I think we're going to have another energy crisis is because the US, 60% of the US oil production is tight oil. Well, that tight oil, according to the numbers that I've read, is basically peaking. They don't have any place else to drill these things, or they can't drill them fast enough to offset the decline rates. I mean, they've drilled thousands of these wells, and the Permian's really the only place left that's growing right now. Eagle Ford isn't growing anymore, and then the one in North Dakota, is it Bakken? No, I can't think. Those two, they're not growing anymore, and so they've already basically hit their peaks. And so we have the Permian. How much more growth can the Permian go, and then when does the Permian roll over? And once the Permian rolls over, it's going to roll over fairly quickly. And I think we're going to have an oil crisis this decade, which is going to be wave number 3 of inflation.
And then how does that start to slow down the picture for the miners as well? Because obviously that's going to bring a lot more cost to mining the metals.
Well, it's actually, in 2024, it's actually kind of a perfect storm for the miners, because you get a recessionary year, which will keep headwinds from oil prices going up. Mm-hmm. So and then gold spot goes up to like 23. I think it's going to go somewhere between 23 and 2,500. So let's say it goes to 2,400. So you're going to add $400 a margin. Once you get to $2,200, you're at 30% margins, free cash flow. That's for me that's where you need to be, 30%. Once you get above 30%, sentiment comes back. I would actually want to talk about this earlier. I'm glad it came back around. Silver miners on margins, they're just getting killed right now. And so most of your gold miners also mine silver. So their silver, all that silver revenue is basically not turning into profit. So that's hurting a lot of the gold miners as well. It's not just hurting silver miners, it's also hurting the gold miners, because most of them have some silver production. Some of them actually have silver mines. So we need silver to get all the way to 30 to get a 30% margin, because their break even is about 21, 22. So silver's got to make quite a move here. But here's the key. Once silver gets to 30, the margins are fine for the industry. Sentiment should return. At $30 silver sentiment should return. You got the margin thing going. And then I expect silver to run from 30 to 50. It'll only take about 6 months is my gut. 3 to 6 months and we're at $50 silver. Once you get to 30, and then the margins start kicking in and the sector should be healthy. You get $30 margins, a few quarters of that is going to be really, really healthy. And investors will have a hard time ignoring those stocks. Real hard time, because 30% margins can really fix a balance sheet in a hurry.
Do you have a feeling, Don, that There was a lot of retail investors that bought silver at, say, around the $28 to $30 level. Do you have a sense that there are a lot of those investors that just want to get out no matter what once they get back to that break-even point?
Well, there'll be more people coming in. Yeah. A lot of people don't think like me. You really have three types of investors. Me, I'm the buy and hold long term. I don't even care about the next year. I doubt I'll sell any stocks this year. Maybe if silver gets to 50, but it's an outside. I don't really care. I don't care. I really don't care about annual returns long term. And then you have people who care about long term, care about annual returns. They have this idea, I don't want to lose money. I just want to have some annual returns, 5, 10, 20%. I'm happy. And so they dabble in these minors because they could get a 50% return on a stock. And so, but they're still focusing short term, and, silver gets to 35 and they got 100% upside and they're out. You have those types. And then probably the largest basket or category is the traders. And the traders, they only care about the next quarter or the day or this week. They don't go much beyond a quarter. And they're the biggest ones. They're the biggest influencers. And so you're going to have, but they will keep buying, they will keep buying up moves. And I think that's what's going to happen. And so then you're going to get new investors coming in. And the new investors that are going to be coming in are, a big chunk of them are going to be your annuals. The guys that are just coming in there going, oh, I'm going to go in there and grab some money for this year. I'm going to go, I'm going to go make, $2,000. They're just chasing, short-term dollars. I think you're going to see a lot of people like that. The people like me, you're late to the show. And once you get to $35 silver, it's too late to be a long-term investor, really, to really make, a killing, if you will. Because back then, Heckler will be up over 100%, it'll be at $8, and yeah, you'll make some money, but you're not going to get a 5-bagger out of it. And so, yeah.
Don, it's interesting. I read a quote from you the other day that you said, when you're going after baggers, don't underestimate the risk required to get baggers. So is that how you, in your mind, you're managing that risk, is by A, buying a lot of them, and B, by holding them for that long period of time?
Yeah, absolutely. People, we see quality companies get hammered. Newmont, if you buy, a lot of people are underwater big on Newmont. If you look at its high in 2020 to where it went all the way down to $34. And I was saying my target for Newmont was 175, which is like a 3+ bagger. Newmont's one of the better companies out there. So yeah, they're all high risk. So I always say keep your allocations low. Try not to go above 1% per stock. If you do, you can have a few at 2%, maybe one at 3%, and be really careful with those stocks. Keep an eye on them, but not too many above 1% is my thesis. I have most of my high risk stocks are about at 2.5%. I really don't care if they go bankrupt. I don't. But this is the way I do it. I don't buy any stock unless if I have a stock that's only 2.5 in my cost basis, it has to have at least 500% upside. It has to have a lot of upside, or I don't own it. And I don't chase stocks. There's a lot of quality gold producers in Australia. Well, not a lot that I don't own. So I have 164 position, but I don't own Capricorn Metals, which I'd love to. They're getting close. They're almost a 4-bagger right now. I don't own Evolution. It's just a little too pricey, and I don't own Gold Road. That's another one I'd love to own. And then Bellevue. Those are 4 producers in Australia. I'd love to own them at cheaper prices. But if I'm going to do a small allocation on them, or, those are all quality. I could do 0.5% easy on those, but I want to get the right price. I don't want to overpay. So those are 4 stocks. Maybe I'll get Capricorn here if we crash. Evolution's a possibility, but I don't think I'm going to get every stock that I want. But those are really the only 4 stocks I don't own that I'd like to own.
Don, there's one more topic I'd like to cover before we wrap up, if we could. And that's the idea of this de-dollarization through the world. Everybody sees this trend happening. So when do you think we're going to see, physical manifestations of the world really coming uncoupled from the dollar? Or is this just a slow evolving glacial process in some ways?
Yeah, I really like this question. And this goes back to when I really became bullish. So I've been doing this for a long time, but I really didn't get bullish because I've always thought that the debt bubble would pop, but I didn't know when or what the trigger was going to be. And I always thought that, it was going to have something to do with de-dollarization, if you will. But the trigger for me was the Ukraine war. Mm-hmm. That's when I said, "Oh, I got the right trade here." I became very, very confident I had the right trade because China basically had an economic war with the U.S. for at least a decade. And Trump figured it out. And Trump said, "You guys, we know what you guys are up to. You guys are taking advantage of us." Trump was the first guy to basically say it. And Obama was trading with China and had no problems with them. But then Trump basically called him out, and he basically put tariffs in place. And then the Ukraine war happened, and China basically showed their colors. Nobody really thought that China and Russia would cozy up so close together. Mm-hmm. I mean, really, really tightly after the Ukraine war began. I mean, chummy. They became chummy after. Now, this wasn't before the war started. It was after the war started. And this was the omen that the U.S. is in big trouble because those are our two biggest enemies by far. Then a third enemy, Iran, they decide, oh, we're going to cozy up to both of these guys. Mm-hmm. So now you have this triumphant. These three countries, our three enemies, are all buddy-buddy. And they want to create an economic system that excludes the U.S. The U.S. will never be invited into the BRICS. But just about everybody else might be. And I think a lot of this has to do with the U.S. snubbing their nose at China and not letting them in the G8. I mean, that's kind of insane. I mean, they're the second biggest economy and they're not in the G8. What the heck's going on here? It's like China, we've been snubbing them for years. Mm-hmm. And China's like, okay, we're going to get our due when we get our opportunity. And the Ukraine war happened, and they said, okay, this is it. We're doing it. We're basically declaring economic war on the U.S. We're gonna ally up with this country they're fighting against, right? Mm-hmm. I mean, we're fighting it. We're literally paying for that war. And here we have China and Russia allying up. And then you have the BRIC expansion, which is underway right now. The Russia right now is the head of the BRICS. They just got it this week. They're the president, whatever they call it, of the BRICS for 1 year. And they're going to have this big meeting in October. It's going to be in Russia. Well, I guarantee you this time, if you remember back in August, they didn't talk about, what they're going to do as far as fund it. We're going to create a token. We're going to create a currency. They didn't even talk about it, right? We're going to work. All they said was, we're going to work on it. I think a one-line thing, but they didn't actually really discuss it between themselves. Mm-hmm. It was a subject that was taken off the table. And the reason why it was taken off the table was because of India. India realized that they were screwed because if you're a net importer, you have to constantly buy that dollar, that whatever that currency is, mm-hmm. because you're not exporting, so you don't generate any. But if you're China or Russia, you don't have to create any currency. You just collect it, right? It works great for you. And Brazil is another country. We're kind of open to it because they're oil producers, and they're going to collect it as well. Mm-hmm. But India was like, we're screwed. And so they basically were totally against it, and they basically shelved it, and they said, we don't want to talk about this here. But Russia, it's going to happen, I think, in October of next year. Guarantee you on the docket, they're going to be talking about, and they've had all this time to basically figure what they're going to do. And what they're going to do is they're not going to use the dollar. And so we're going to find out what their plan is here next October. But this summer, it'll all leak out. Mm-hmm. Their plan's going to leak out this summer, right? Whatever they're planning to talk about in October. And I guarantee you, India is going to be furious because one way or another, India is going to be the odd man out. It's like because they don't make enough stuff. Well, guess what India is going to need to do? They're going to have to start making something. Start inviting in, the chip makers, and they need some exports. If they don't have any exports, then here's the irony of this whole thing is that guess who the net importer is right now? The US, right? So the BRICS are basically showing that, it's not a good thing to be a net importer. That's a bad thing. And they're basically, showing how the only reason why we've gotten away with it is because it's the reserve currency. But if it's not the reserve currency, then you're in a bad position. And that's what's going to happen to the US. I actually think that we're going to have a reset in 2027. I think the US, this whole debt bubble is going to begin to pop this year, and the Fed will do everything they can for about 2 more years to keep it alive and basically try to get the US economy back in order, but they won't be able to do it. And then throw in the towel in 2027 and devalue. Basically, I think what they're going to do is they're going to do away with the old dollar. Everybody will have to turn in their dollars. You want to be forced to do it. And they'll be able to do it through crisis. So the crisis is that, hey, we got to default on our debt. And so I think what they're going to do is they're going to orphan all the external dollars and basically say, well, they'll let some of the electronic dollars come in, but if your money is if you acquired your money in an illegitimate way, you won't be able to get them back to the U.S. You're going to have to prove where those dollars came from. Basically, I don't know exactly how they'll do it, but I think because they don't want all those dollars to come flooding back, so I think they're going to orphan quite a few of them, and then they force us all on CBDC. They basically say that this is the new currency, those old dollars, and that's how they devalue the dollar, because they'll basically, once they have the CBDC, they'll say it's worth this much. It'll be interesting to see how they do the reset, but I'm expecting a reset. 2027 is my target.
So you think that's the route they go instead of trying to revalue the gold that they have or trying to sell more debt and thereby sacrificing the dollar? They're just going to outright default.
They don't have a choice. It's their only option. There's no way that they're going to use a hard currency. They use gold back. That just makes zero sense. And it makes no sense that they're going to be able to just keep the system going, which everybody thinks is going to happen, that they're just going to keep it going. They're just going to keep expanding debt. It's going to go to 50 trillion, 100 trillion. People think that's going to happen. And I'm telling you, it won't work if foreigners don't buy our debt and if foreigners dump our debt. And so their only choice is CBDC. But the thing that's beautiful about CBDC for government is it allows them to basically do away with the black market. Black market will be dead. They'll use crypto for black market. But the dollars they'll be able to track. It's really interesting. The IRS, I couldn't believe this. It kind of blew my mind. But the IRS actually put a new law into place that's just total insanity. That went into effect for fiscal 20 for right now for 2024. If you do a crypto transaction over $10,000, you personally, not according to the IRS thing, it's not an exchange. It's the person who did the transaction, either sent or received. It doesn't say. It just says if you did a crypto transaction over $10,000, you have to report it within. Here's the insanity part. I don't have a problem with it if you report at the end of the year, but you have to report it within 15 days or else it's a felony, not a misdemeanor. If you don't report it within 15 days, it's a felony. And nobody even knows this law's on the books. But here's the thing that's absolutely insane is that the IRS did this. So if you're a bank and or you're an exchange, let's say you're an exchange and you get, because I think we're going to start hearing more about this, and somebody does a deposit of $10,000, they got to report this stuff to the IRS within 15 days. It's like somebody put the thing up there. It's clear as mud what the IRS actually is expecting, who to do what. who has to report when, what type of a transaction. It's clear as mud. It just says if your transaction is over 15,000 within 10 days, over 10,000, you have to report it within 15 days. Mm-hmm. So that, I think, is the beginning of they're going to they have to somehow get their arms around crypto for the black market, because if they try to do away with the black market, they're just going to make it, the crypto world is going to take that all over, and it can become a big mess for them. I don't know, but I am expecting CBDC to be released, and the only way they can force it on you is to basically do away with dollars. It's the only way I see it.
Well, it's interesting to see this in some ways almost like a catch-all legislation that was just put in for that. But on the other side of that, we've seen a lot of reports, like I believe it was out of Florida, and I think there was a couple other stories that I read that said that it's basically legislation that is introduced against CBDC. So is that not a positive indication to you that there are people that are thinking about this and resisting it already?
Yeah, there are, but as long as the national government exists, anything the states want to do is irrelevant, kind of thing. The states, they trump it. It's like we have a national currency, and we have a national government. Now, down the road here, I actually think that 2024 is year zero. This thing's out in left field, what I'm about to say, but I feel that 2024 is actually year zero for basically point forward of where America's heading. And what I mean by that is that after this year's over, we're going to start ignoring the past, because the past will be irrelevant. And the reason why it'll be irrelevant is because we're going somewhere new. The old way doesn't work anymore. So I don't really care about history, because the old models are so broken that I don't even need to pay attention to the past anymore. I don't need to pay attention to the news. Everything you say is just gobbled, blah, 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 because we're going somewhere new. By the end of the year, everybody's going to realize that the old way doesn't work. And part of this is going to be the election. I don't know how that's going to unfold. Part of it will be the election, but the bigger part is going to be the economy. So you had 2016 was basically the year that politics broke and the media broke. After Trump was elected, there was basically no debate in Washington anymore. Debate died. Mm-hmm. And then the media basically split apart and basically said that, the media said, well, we're not going to do our job anymore. We're not basically what they said. We're just going to stop doing our job. And they quit doing it. If you think about it, starting in 2016, people stopped watching the news. They stopped. They're like, I'm not going to watch that. And even Trump even called it fake news, which is a great title, right? Because he's basically right. It's like, can't believe a thing they say. They all have an agenda. And so in 2016, you had the politics died and the media died. Then in 2020, our institutions died, where you can't trust them. So, first it was basically the FDA with the vaccines, and then the CDC, and you couldn't believe a thing they were saying. Then it was basically the FBI of all people, the Treasury Department, the Border Security, Department of Homeland Security. Anything you couldn't believe a thing they said. The Defense, it got to the point where we couldn't even believe the Defense Department anymore. You remember Afghanistan? We were trying to get them to tell us what their plan, why were they doing all that. Nobody believed a word they were saying, right? It was like, so our institutions basically died in 2020. In 2024, I believe that our economy becomes dysfunctional. Now, it's not going to die. Well, I think you can go back and say, in 2016, our political system became dysfunctional. Our mainstream media became dysfunctional. And then 2020, our institutions became dysfunctional. And in 2024, our economy is going to become dysfunctional. And we're going to know it. In the U.S., the one thing about the U.S. is the U.S. has always been basically since the 18th century, 19th century, it's always been a country of individualism and small business, family business, and success. You know, the Horatio Algiers story kind of thing. And in the land of dreamers, the land of freedom, and all that, you could accomplish whatever you want, potential to everything. Well, after this year, everybody is like, no, we're screwed. There's this one guy on Twitter, and he's been tweeting for a few months now. He says we're all effed, and he's so spot on, but he doesn't even realize it. He's saying we're all effed because of the economy, but he's connecting the dots because America is basically a corporation, and once that a corporation stops working, the whole system breaks. Now, in tandem with the economy becoming dysfunctional, the one thing that I haven't mentioned, which is also dysfunctional, is the culture. You know, the culture wars that have all picked up. That is not getting better. That's getting worse. So the country is fragmenting. I mean, we got the open border situation right now, which is a major problem. That's why I said this election in 24 is going to have a big impact of what I'm talking about. But by the end of this year, once the economy becomes dysfunctional and we start to recognize that, we're getting a new normal, but the new normal is going to be much worse than the old normal. This is bad. By the end of this year, I think people will be saying this is bad. And that's why I call it year zero, because 2025 and 2026 will be even worse. These are going to be the worst 3 years since the Civil War. And in many respects, it'll be worse than that, because not only will you have the political fragmentation that you had from the 1860s, but in tandem with that, you'll have an economic system that basically you can't fix. And back then, it was easy to fix economies. We had a lot of major recessions back then, but we always came roaring back. Not this time. This time, we're all going to recognize that it's a new game, a new structure. And this is when people were going to, and the end result's going to be, and I don't know when this is going to become evident. It could be this decade, might be next decade, that our national government's going to go away. It's going to go bye-bye. And the reason why is because initially there'll be sections of the country that'll just split apart, will split away from it. And so they'll lose their influence, if you will. And then more and more places will basically secede away. And then initially it'll become irrelevant. And so I see Washington. So right now the Fed is irrelevant, and over the next few years, Washington will become irrelevant as well. That's the future of America, which is pretty ugly in the near term. But the good news is that these new regions, when they start over, they're actually going to start from a place. America has its founding. America was based on freedom and liberty. So that will be the foundation of these new eras. And the one thing they're not going to allow is the government to be too big and strong. So there could be small governments with freedom and liberty, which is what we want. And so it's kind of a start over scenario, which will be very, very positive for the country. But it'll be countries. It won't be country anymore. That's kind of the bad thing.
Mm-hmm. Don't you think, though, that they're like speaking about it in that way? No offense, Don, but it's a little too generalistic, because there's a lot, I would say, in my experience in the US, there are, big portions of the US that want that liberty and the freedom, but there's also big pockets that want things taken care of for them. They want their, electric cars. They want all of the things that modern society provides that doesn't necessarily include taking responsibility for your own financial well-being and
right,
entire life.
Right, and that's exactly what's happening right now in the country. That's why the political division has never been this extreme, because you definitely have two different thoughts of what governments should be. But what I'm saying is that those ones that want basically the old American, liberty comes first and the government comes second kind of mentality, small government, if you will, those will be the first regions to break away.
Mm-hmm.
And the ones that try to hold on to the other way, where the government tries to provide, I just think they'll be object failures. They won't work. And so eventually they'll do the same thing. They will basically go their own way. There's like, Washington's not helping us. We got to figure this out on their own. I think they will try. They will try to use that type of a big government approach, but it never works. I mean, Venezuela is probably the best example. It just doesn't work.
Mm-hmm.
Government cannot solve problems. It just creates bigger problems. So, like I said, they will try to do it, but it won't work. Mm-hmm. And the places that thrive are the ones that allow people their inherent freedom. Because, I mean, let's face it, each individual feels free. I mean, I don't know about you, but I intuitively feel like I have free will. And I want to use that free will. It's like God-given. I've gotten this God-given free will. I want to use it. I don't want somebody to tell me how I'm supposed to live my life. Don, you have to go to bed at 10 p.m. We're going to turn the power off at 10 p.m. And then we'll wake you up at 5 a.m. That type of thing. Big brother. I was like, that doesn't fit well with me. I don't think it fits well with many Americans. Most Americans want their freedom because America's built on that concept. And I don't think the idea of freedom will go away easily. I don't think it will go away at all. I think the majority of Americans believe that, and the rest of the world admires us for it. They admire us for this idea of liberty and freedom. That is, the ultimate, way that humans should live. Everyone should have self-determination. And so that's the future, I believe, is that, and America is the perfect place to create it. It kind of died in the 1960s. In the 1960s, we actually had the opportunity to go down that path of basically freedom and liberty, and not a big government. Mm-hmm. Don't let government get too big and not, ruin it, if you will. Ruin our freedom. But, what started in the 30s just exploded in the 60s and 70s. We didn't, if you go and you listen to Kennedy in the early 60s, if you listen to some of the stuff that he talked about, I mean, he really, he didn't want government to get too big. He wanted government to do its job, but we want freedom. The will of the people needed to be at the forefront. I think, kind of his anti-Vietnam stuff was like, wait a minute, in what interest is that for the American people? Let's say the overall thing. I think he was kind of a focus. That was the last time when government was working for the people and not for themselves. But once you start thinking about the government being the best decider of how we live our lives or whatever, big government work. If you think government works, once you start down that path, it's a slippery slope, and that's the path we went down. And America, in my opinion, died in 1963. Mm-hmm. We just haven't had the funeral yet. And so now it's going to be, I don't know what they're going to call these new regions, but I don't think it's going to be the United States of America.
Well, I would assume that if a place becomes that fractured, they're going to want to declare it, this is a new starting point. We're starting something, or we're correcting from our old ways or where we got to. So I agree. I don't think it's going to be called anything, very reminiscent of the States, if that's so what happens.
Yeah. So, yeah, I think it starts this year, that whole fragmentation, that move towards change, move towards something new, move towards something that works. Mm-hmm. And I think that this political election is going to be a big part of it. In other words, whoever's elected will not be accepted by America. I don't know how that's going to unfold, But Trump was basically not accepted by a big portion of America. Could be him, possibly, but whoever it is, there's going to be a big portion of America where he is not accepted as the American president. It's like, and so the fragmentation basically takes on a new life, if you will. And then when you, in tandem with that, with the economy stumbling, it'll start to spur, more fragmentation, if you will. I do think that one of the things that's going to come out of this election, somehow that the border problem is going to get resolved. I don't know how, but that one's really interesting to me, is that because the border issue and you have a new election, those are huge. Both of those are huge. Those are going to, and then the other point is this concept of what I call going your own way. I think this will manifest. If it doesn't happen in 2024, I expect it in 2025 after the new president comes in. And this is where states basically ignore federal law. And they basically say, no, we're going to create our own law for that. We're going to ignore yours. Now that hasn't really happened before. And that's going to be the beginning of the end of our state system. Because our state system is based on this idea that we adhere to federal law.
Well, there's sure a lot of turbulence, I think, in the year ahead. There's sure a lot of problems that need to either come to a head or be solved, Don, and I appreciate you kind of giving us your perspective on all of this stuff. Is there anything that you want to touch on before we wrap up here?
I'm on Twitter most days. You guys can follow me there, Don Durrett at Twitter, and then
2 R's, 2 T's.
Yeah, and then check out my website, Gold Stock Data. If you own any gold and silver mining stocks, it's basically for just gold and silver mining stock investors.
And you also have a Substack, dondurrett.substack.com, right?
Yes, and I'm also on Seeking Alpha.
Perfect.
Right,
excellent, Don. Thanks so much for your time today. Really appreciate it.
Yeah, thanks for having me on.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.